Welcome to another episode of Real Estate Unfiltered with Bridget
And Angie.
And today we're talking about
Credit. One of the key things that you need to buy a house. But I feel like it's not talked about enough. You know, I don't know that it's even taught in school, honestly, on what a credit score is or how to create one. I feel like a lot of it is either through trial and error, or if you have parents who are in, financial positions, that understand credit, they can help educate their children on it. But I feel like, because I didn't have that growing up, I didn't know.
No.
I mean, did you?
No.
Yeah.
Not at all.
So I feel like I've built my credit score from, 18 on just by trial and error. And then I learned a lot in this profession, like a lot. So I feel it's something that it isn't talked about enough, and it goes, it holds such a huge, I guess I don't know how to word it. It's a big deal.
Yeah, I know what you're saying.
Like if you want to buy a house, the important part about credit is it shows your ability to repay. And that's kind of the key driving factor when it comes to qualifying for any kind of loan. Yep. Not just a car loan, or not just a mortgage, a car loan, credit cards, anything. And that's why a lot of times, like for student loans, parents need to co-sign on them because the kids don't have the ability to repay. It doesn't show that they can. And that's the biggest thing, is you need to be able to show the creditor that you have financial responsibility, and that you can make your payments on time, and however, whatever amount they're scheduled for. It's important to understand how crucial that is.
Right.
And when it comes to a credit score, there are so many different modules. Like everything is rated differently depending on what you're applying for.
Right.
Which makes it more complicated on my end when borrowers who, and nothing wrong with this, but when borrowers use Credit Karma. I think Credit Karma is great when it comes to tracking your credit score. Right. And not your score, tracking your credit. Because you have Credit Karma, don't you?
I have Credit Karma, yeah. And I just looked and it dropped like 40 points. And
really?
Yeah. And I'm like, whoa, what happened? And so I clicked to see events. There's nothing new in there.
Yeah.
So I don't know.
Did you pay anything off? Because sometimes that happens too. If you pay off a liability, like an installment loan, and your score goes down, which people are like, why is that happening? It's because you're closing out that line and that ability to repay is gone, But so Credit Karma is really great though. Like if somebody were to pull your credit for anything, you get notified immediately.
Right.
Right?
Yep.
Yeah. So it's really great for monitoring your credit and knowing if anything funky is going on, with your credit score, or just, anything in that. So it's great for monitoring credit, seeing what's important to credit bureau, but not always the greatest when it comes to a credit score.
Right.
Because again, there's different modules for ratings. So your score may have gone down 40 points in Credit Karma, but if I put on my end, maybe 20 points or maybe 60 points.
Right, exactly.
It's such a huge range on how they create credit scores that it's not an accurate tool for knowing what your credit score is for a mortgage. Right. I've seen it before where it's like 100 points off.
Oh yeah, mine. Yeah, a long time ago, a couple of years ago, I still had. I had Credit Karma at the time, and I got a number for I knew my number, my credit score number. And then when I went to go get the auto loan, they told me what my credit score was, and I was like, no, really? I didn't want to argue because it was way better.
Yeah.
So
yeah.
It's
not accurate. I have found though that if your bank offers it, like I have one through where we have our one of our savings accounts through. If your bank offers it, those seem to be a little bit more accurate. So I would recommend checking with your bank to see if they offer some kind of like a credit monitoring system, or even if you have a current credit card like Citi or Discover or Chase, like they have great tracking as well. Like those scores seem to be a little bit more accurate.
Yeah, because after I've seen my score dropped, I went and checked Citi because that's nothing changed. So was it a glitch? I don't know. Technology and stuff. So I panicked, and then I checked another source, and then I was like, all right, I'm not going to worry about it.
Right. Yeah. And that's the thing and most of those only show you the TransUnion score. Did you know that there's 3 credit scores?
I did.
Yeah, but did you know there's 3 credit scores? Experian, TransUnion, and Equifax. Now, most things that you apply for only pull 1. and that's going to be TransUnion, because TransUnion is the #1 reported agency for the Midwest. So everything in the like for people in the Midwest, it reports to TransUnion. Everything reports to all three of them, but TransUnion is the most commonly used credit agencies. But we pull from all three, which can be a good thing also, because then we get 3 different scores.
Right.
So explain the logic to that. I have no idea how that happened. I wish I could. I'm not going to come in and say that I'm a credit expert, because I'm not. I know how to read credit reports and I know how to understand them, but how scores are created, I couldn't tell you.
So seeing you as a mortgage company pull 3 credit scores, what do you use?
The middle.
Why?
Because that's average. Yeah. So like if your score is like a 580, a 720, and a 780, we'll use a 720. I mean, they're not gonna be that huge of a range.
I was
but
going
I'm
to say,
just
are they
saying,
that huge of a range?
sometimes there's like a 100-point difference between them, which again, how? Couldn't tell you. But so we use the middle of those 3 scores to qualify, which can be a good thing, because then you have, flexibility in your credit score. And then if you're applying jointly with somebody, we use lower of the middles. So if your spouse has a 700, you have a 780, we'll use your spouse's lower of the 2 to qualify. So we're more conservative when it comes to interest rates in that regard too. But just a couple things to keep in mind when applying for a loan is like how to make your credit profile look better for a mortgage, because we do offer, I should side note, we do offer no credit score loans, which is kind of cool. Like if you have literally no credit score, because you're either 20 years old, had never financed anything in your life, or because you're 20 years old, or if you pay for everything in cash, you've never done a loan for anything, like no credit card, no student loan, no nothing, your credit score comes back as NA. Because I've seen that come back where it says no score, like not applicable for all 3, so it's like 0. So we do offer loans with 0 credit score.
Is that new?
No, you need assets to back up your inability to have, your assets to back up the lack of a credit score. So you need to have money to put down. You can't just put 5% down with a 0 credit score. It doesn't work that way. So if you want to put less down, you need credit to make up for what your assets don't have.
Okay.
If you have lower credit, you need assets to make up for your credit. So it's like a weighted scale here. So you need to have one or the other to make things look more appealing to the investors. And then Fannie Mae released last year, they removed their minimum credit score requirement, because before it used to be we had to have a 620 or higher to qualify for a conventional loan. Fannie Mae said, no, you can have any credit score as long as you have the assets to make up for what your score doesn't show. So I closed somebody a couple months ago, she had a 534 credit score.
And it was
and we closed conventional.
Really?
Mm-hmm.
Holy cow.
Yep, she put 20% down. You have to have the assets to cover, because you can't get private mortgage insurance with a score that low. Like you can't there's no way that will insure you with a score that low. So she had the assets to make up for what her credit didn't show.
Wow.
So that's one thing I want people to understand is, just because your score may not be where you want it to be, doesn't mean that you can't get a house. But if you don't have the assets, then we're going to have to try and figure out how we can build your score up. And a couple ways to do that is one, make sure you make your payments on time. Even if you have, credit cards and the payments are $30 a month, but you try and pay like $1,000 a month. If you try and pay off every month, if you can if 1 month is tight, at least make the minimum monthly payment, because that's a big deal. Just making that monthly payment. Yeah, you're not going to get anywhere in regard to paying down the balance,
right? But
you're making your payment on time, and that is what is important. Is to show that you have the ability to be financially responsible and make your payments on time as scheduled.
Yeah.
If you can pay above and beyond what is owed, great. Because credit cards can literally cause your credit score to be a roller coaster. It will change every single month. And I feel like probably everybody has seen that. 1 month, like during Christmas, your credit card bills are crazy high because you're buying all these presents. The score goes whoop, and then you pay them off and it goes right back. So it's like a huge roller coaster. So it can be disheartening sometimes to see your score change so much. But usually if it goes down, okay, well, what is your utilization of your credit cards? Correct. If you max out your credit cards, your score will be impacted by that. Even if you make the payments on time, again, it shows your ability to make a payment on time, but your score is still impacted because you max out your lines of credit that are available to you. So the magic number is to try and keep your credit cards at or below 30% of their available balance. It's kind of like the rule of thumb to keep things to benefit your credit score. So if you can't pay off your credit card, can you just pay it down?
Right.
Like it's because sometimes paying it off is not an option.
Yeah.
So trying to keep those under 30% and then making payments on time as scheduled is a big one. One of my biggest pet peeves, and I hear the commercials all the time now for Dollar Loan Center. So I don't know how those are structured. I've not seen one of those in a credit report yet. So I'm sure they're going to be, because they just put a new one here in town right next to Starbucks, and they're literally everywhere. They're popping up literally
I've never
everywhere.
heard of them until it came here.
Yeah. I get the commercials, the don'tbebroke.com, and so you get like $5,000 instantly in cash. Yeah, but your interest rate is like 400%. Like you pay so much in interest to get it. Which there's a time and a place for everything. Okay, and I'm not saying that if you use those as a bad thing, but it affects your credit score more than you think. Because I've seen this before with One Main Financial, and what is the other one? There's another one. So there's two of them that people use, when you get those checks in the mail. You cash a check. Here's $2,000 or whatever. You cash it. You don't read the fine print. Your interest rate is crazy high. You make the payments, but here's where it's bad, and what it does to your credit score is you make your payments on time, which is great. But then they say, hey, you've made your payments on time for the past 6 months. Let's refinance your loan, and we'll give you an extra $500 or whatever. But let's refinance it. You say, oh, okay, great. I get some extra money, refinance to a better, however the terms are for it. It's closing that liability because those are installment loans.
Yep.
So you are opening and closing debt multiple times a year. Usually it's every 3 to 6 months. So you're constantly opening and closing these. And that is what caused your score to go down drastically, because you're constantly opening and closing debt. Your score will go down whenever you open a new line, line. So if you buy a new car, you buy a house, if anything that you finance, your score will go down with a new liability. It'll go back up as you make your payments on it. And the same thing is if you constantly close things out, your score goes down.
Like opening an auto line of credit, for a car loan, and then closing it and then reopening it. I mean,
yeah, not good.
No, it's not.
Not good. It does not look good. So it does not look good in your credit report. Like you want to, even if you buy a car and you finance it just because you want to try and get a credit score built, which is great. Don't open up a line and then pay it off in 6 months, because it isn't going to do you any good. I know yours wasn't that way, but
how about in a couple weeks, maybe a month?
Yeah, don't do that. It's not ideal for your credit. Try and keep those open. If you want at least like a 24-month payment history, is 24 months is the minimum, but because you want to show your ability to repay. So even if you can pay it off, I recommend keeping it, because it's going to help you in the future if you ever want to finance anything. So I know my brother had to do that. He had to finance, because he paid everything for in cash, but then he wanted to buy a house. So I need to build a credit score. So he financed, and he's like, I could pay it off right now. Like, but don't pay it off right now.
Right.
Just keep on making those payments. Because, paying interest sucks. I get it.
Yeah.
But also, if you don't have a credit score, you can't finance anything.
If you paid off at the end of every month, or before, it's been purchased for a month, you're good. You're fine, which is what I try to do all the time. So
you mean for a credit card?
Yeah.
I'm saying for for a truck loan or a car loan, like paying interest on a loan sucks.
Oh, that way. Oh, sorry. Never mind. I was on a different track.
Yeah, but you are true though. So if you do have a credit card and you pay the credit card balance off in full, you don't pay interest on it. So a credit card can be a valuable tool when building a credit score.
Yep.
Because of that reason.
Right.
So it's important to know that, it's not free money, but it helps you build a credit score without paying interest on it.
Well, it's like a loan at no cost, as long as you can.
0% interest loan.
Exactly,
as long as you pay it back.
Exactly, within a month, you're good.
Yeah. Credit cards are a very valuable tool if they're used correctly. They can also be very dangerous if you don't know how to balance your finances. So you can be like, oh, I'm just going to charge it, and then you get a credit card for $10,000. Well, now what?
Right.
You know,
yeah,
and if you don't pay it off, the interest compounds on that bad boy, and you're constantly paying interest on it. I learned that the hard way on my credit card. I missed a payment by one day. I went in and made the payment. I was like, okay, I'll just pay the late fee because it's totally my fault.
Yeah.
You know, I think it was like a holiday or whatever. I missed it by one day. I was like, I'll just pay the late fee. That's my fault. Well, I paid the interest on it, and then the next month I got billed again for interest. I said, I paid my credit card off in full. Why am I being charged for interest? And somehow how it backdates and compounds, like you pay it for 2 months for one bill. I was like, thankfully they reverse it because I thought that's insane. Like I paid the interest because it was my fault. I paid my dues, but I got to pay it again.
Yeah, I think the same thing happened.
Yeah.
To the same credit card
Yeah.
between you and I.
I was
Yeah,
like,
and
what is that?
Yeah, and I was like, no, I paid it off. What are you talking about?
Yeah. So
Yeah.
I learned that lesson, the hard way, but it happens. I mean, life happens. You forget things,
Yeah. Yeah. I mean, mine I don't think was late, but I paid it off. But then yet the next month I still had to pay because somehow it was
You probably
interest
had like a $1 balance left
or
over when you
something.
pay it,
Yeah,
something
and that
crazy like
interest,
that. Yeah.
exactly. And I was like, what? I paid
Yeah.
it off. There's no charges. And yeah, then they explained it, but then yeah, they did take care of it too.
Yeah.
So
So if you have a history of paying it off in full, they're usually pretty lenient with you. Another way, if you want to build credit without using a credit card because you don't trust yourself to have one, which is totally fine, some banks offer secure credit cards. Where they'll give you a credit card. So you say, okay, I have $1,000 that I want to use, or 500, or whatever you have. The bank will hold your money as collateral, and then they'll give you a credit card in exchange for that. So kind of like a car loan. They hold your car as collateral. If you don't pay your car loan, they're not take your car.
right.
So if you don't pay your credit card bill, they're just going to take your money and pay the loan off, and then it's going to hurt you. It's really going to impact your credit score if you default on a secured loan.
Right.
But secured liabilities hold stronger and help build credit faster than unsecured liabilities.
Yeah, absolutely.
So, yeah.
And that could be, leading the credit score into like another segue that has been talked about a lot lately is foreclosures.
Oh.
They are high right now. And instead of letting the house go back to the bank, maybe reach out to somebody, see what you have for equity in your house, and at least sell it. So, you don't lose all the money you've already invested into your home.
Because the bank isn't going to give you anything. If you foreclose, you get nothing.
Exactly.
You get kicked out.
Yep, exactly. So, see if there's equity, so then you get, your money, some of your money back. And then you also avoid the foreclosure on your home.
Yeah, because if you have a foreclosure in your credit report, that's bad. Like you have to wait 7 years to buy a house.
Do you have to wait 7 years?
For conventional, you do.
For conventional, okay.
For FHA, I want to say it's 3. So FHA is good, but I mean, it's not going to be easy.
Right, because then, obviously you're going through, a different loan program, higher interest rate, you're more of a risk. So yeah,
and it's 7 years from when the foreclosure is finalized. The foreclosure process can take up to a year and a half. Like it's a long process, but if you foreclose on a home, I mean, like I said, your ability to repay is the key driving factor. So trying to get an approval with a foreclosure in your history is not going to be easy.
Right.
So to try and avoid that is going to be even if you don't foreclose, you have those late payments, you still have to wait. You can't buy a house, you have all those late payments in your credit report because they're all going to show up on there. So you still, even if there is no foreclosure, you still can't do anything immediately because you have mortgage rates.
Right. Which doesn't look good if you go to get a new mortgage.
Correct. So then that's either way, if you ever want to buy a house in the future, it's going to take you a while.
Yeah.
I want to say it's at least 12 months of no mortgage rates, depending on how long they are. Some of them are 24 months.
Wow.
If you don't foreclose.
Yeah. So if you are in trouble with your home or having a problem making your payments, please reach out to me. I would love to do, a market analysis for you to see what we could sell it for and how much money we can put back in your pocket and you don't hurt your credit.
Yeah. Because if you're in pre-foreclosure, that doesn't affect your ability to sell it, right?
Correct.
Would that be considered a short sale? Or what's considered a short sale?
Lauren, cut this part out. I don't really.
Isn't a short sale where you just sell it?
You can sell it for what you owe to the bank per se. So a short sale, there's special education into it that
Okay.
you have to do a short sale, or the lender helps you with it. But basically, you have to have it approved by the lender. So it takes
Okay.
so much
So you're
longer.
not getting, so then you're not getting the equity out of it though, because the short sale is done by it's probably, is it initiated by the lender?
No,
Oh,
you
it's not.
can't. No, you can. Well, the lender will basically almost foreclose on you. You can reach out to say, hey, can I just sell it for what is owed to you? And that's essentially like a
Oh, okay.
short
So
sale.
instead of going through like the foreclosure, okay. So
Mhm.
that's not what you do then. You don't do short sale. You do an actual sale where they could walk away with some of the equity if there's equity in the house.
So Lauren, you can pick up that.
Yeah, yeah.
Yeah, no, like if
I was
they,
just curious what the difference was between those two.
yeah. So like if you get a letter saying you're gonna get, foreclosed upon, or anything saying, hey, you're behind, reach out right away.
Yeah,
Let's get the ball rolling. I have several different options, for you and what might work best for you.
yeah.
So
You have some
yeah, yeah.
investors too that might help out depending on
Mhm.
what condition the home is in.
Absolutely.
Yeah.
So yeah, know your house, know your value in your house and stuff. So before you just say, well, I'm walking away, reach out. Let me do,
Yeah, you don't want to abandon the house when there's options available to you before you do
exactly.
that.
Let's do a market analysis to see if there's any value in there and see about getting it sold quick.
Yeah.
So,
Especially right now, the market it needs houses. I mean, there's
mhm.
not that many houses on the market right now. So,
No, there are not very many houses on the market.
oh, the good old spring market with a housing shortage,
Mhm.
you know. But yeah, so I just wanted to just do a quick episode on credit because I don't think it's talked about enough, and most people have no idea like what's even on their credit report. Like if you have medical collections, like those are going to hurt your score continuously. They have brought in some laws where if your medical collection's under $500, they can't report to the credit bureau,
Mhm.
which is a good thing.
Yep.
The collection is still there though; it's not going to go away.
Right.
But they don't put it on your credit report because I've seen collections before for like $20. I was like, what the heck, really? Like, but those collections actively impact your credit score in a negative way. So even if you have two medical collections, you have a couple positive things, those two are going to counteract each other. So you're fighting for a better credit score, but you're not going to because you haven't taken care of the yuck
Right.
that's on your report.
Right. Yep.
And that's one of the nice things too that we offer here is one is we do soft pulls on credit,
Mhm.
which is not a hard pull. So a hard pull will actually show up on a credit report and it does drop your score. I mean, not a lot, just a little bit.
Yep.
When a hard pull is done, and then it'll go back up. But a soft pull lets me see your entire credit profile because I can pull all through credit bureaus with a soft pull. I can see your whole profile and say, okay, your score is this. And then if it's not where we need it to be for whatever you're trying to apply for, I have a credit simulator that will run your credit score through a module and say, okay, if you want your credit score to get up to this, do XYZ. So it spells it all out that says, okay, pay this credit card down to this balance. Or sometimes it says open up another credit card because you only have 2 trade lines
No, that's
reporting.
funny.
Yeah. So it says to get a third because the magic number is 3 trade lines. You want to have 3 active trade lines, even if you don't currently use them. Like, for example, your Kohl's credit card. Like everybody has it. I mean, probably people now, like who are in their 20s now, don't have Kohl's credit card. That's a thing like for the millennials.
Oh, in their 20s.
Yeah.
Yeah. No, I have a Kohl's credit card that is so old, but because of the payment history and the
Do
long-standing,
not close that
exactly,
credit card.
that would kill my
Yeah,
credit
you
right
do
there.
not
Yeah.
want that payment. And that's the thing is too is people will, and I did this a lot when I was younger too, is I would pay for a credit card and I would close it.
Yep, I
Like
did
I
that
was like,
too.
I don't want it. I don't want that. I don't want that temptation. I don't want to use it again. I paid it off. I'm proud of it. At 0, close it. Don't do that because then you lose that payment history goes away, and that's what caused your score to drop down.
Yeah,
So if you close that Kohl's card, oh my gosh.
I don't even, and I obviously you can't just leave it sit there forever and ever and ever because eventually
I think
believe
it's
it,
3 years of an activity before it closes itself. But I think they let you know that says, hey, your account's about to close.
Yeah.
If you do nothing by this date, it'll automatically close. Or if you need to use it, just go buy something real fast.
Right, and that's what I do with my Kohl's Black Friday.
Yeah.
And that's really all I ever use it for.
And the nice thing too is with the Kohl's card is you use it and then you can go ahead and pay it back right away while you're at the register.
Right. Yep. Exactly.
So you reactivated it, but then you paid it back right away. But that brings me to my other idea, or my other thought too, is if you get a credit card and you use it to buy gas, you know what, because some credit cards have really good gas, reimbursement. You use it to buy gas, you go home and pay it off right away, you're not going to help yourself.
Yeah.
Because the payment that you just made is not being reported to the credit, because the credit bureau doesn't see your active everyday transaction history.
Right.
It doesn't see that. It just sees when your statement cuts and when it closes. So your statement cuts, you owe whatever amount of money. You make that payment on or before your due date. That payment reports to the credit bureau that you paid your credit card, whatever amount you paid, and then the cycle it just constantly. But if you pay it off before the statement even cuts, it's going to cut with a zero balance.
Yep.
And then you don't have a payment to make, so so it doesn't show anything. So it doesn't really help you either. So I just say just use it wisely, but then wait till your statement, because your statement usually comes out like 2 weeks before it's even due. I want to say it's like 2 or 3 weeks it comes out.
Do you think it's that early?
Yeah.
I'll have to look back and.
Yeah.
I always thought maybe it is. I always thought week, maybe 2 weeks.
Yeah, I want to say it's like 2 to 3 weeks.
I think you're right.
Yeah, because I just got my statement this week for my credit card payment that's due beginning of July.
Yeah.
So I want to say it's like 2 to 3 weeks you get your statement. So then and then at that point you can make your payment because the statement has already cut. So when you make your payment, it'll report to the credit bureau that you've made a payment, and that'll help your score.
Right.
But yeah, it's just all these different little nuances, when it comes to credit, that I wish more people understood it. And I wish it was talked about a lot more, because it's surprising, because most people think that debt is bad, and cash is king, which I agree. However, unless you plan on having $200,000 in your pocket to buy a house in cash, you're going to want to build some kind of credit score.
Right.
Or have assets saved up to be able to put enough money down to where your credit score doesn't matter.
Right. Yeah, for sure. But I'm sure there's people out there that will watch this and go, wait, what?
Yeah.
I don't know when to purchase and pay, or,
Yeah.
It's a learning curve. It really is. And eventually you do figure it out, otherwise just ask somebody.
Yeah.
Like, happy to help, right? Because what you don't know, you don't know. And
I didn't know a lot of it when I was, growing up. I learned a lot of it either just through doing, and then also through my career.
Correct.
So you learn a lot as you get older, and I feel like if your parents don't teach you it, how are you going to learn?
The school sure as heck doesn't.
No.
I know my oldest, Kylie, she learned about her credit score when purchasing a house. And now she's ridiculous with that score.
Some people I always find it really funny too, is when I have borrowers come in who have a joint credit report, they always compare credit scores. They go, mine's better than my, so it's always funny to see the competition between, couples on what their credit scores are if it's joint. But yeah, it's become, but if you watch it too much, it's kind of like the market. You try to watch the bond market, like it's sometimes you
That's Kylie though. If you ask her, like if I were to text her right now and say, what is your credit score? She'd respond like that, because that girl knows. Like,
yeah,
she's very anal about it. And yeah,
it's important. It's important to know what your credit report looks like and what your credit score is.
Right.
And you do get a free credit report too. You can go to myfreecreditreport.com and it'll give you a copy of your report. I don't think it gives you your credit score, but it shows you what is on your report. So if you've never looked at your credit report before, and that has happened before too, where I have clients who've never even seen a credit report before. Yep. So then I go through and show it. I was like, you'd be surprised what is on there. It shows your employment history. It shows your address history. If you were married and divorced or whatever, it shows every variation of your name. Like, it shows all of that, everything you've had in your credit report. Like, it's very in-depth.
It is.
And people are surprised, like, because it shows, because your employer is on there, because your employer gives you a W-2, they have your social, they report your employment to the credit report. It doesn't change your credit score, but it shows,
right.
Or even wherever all of your address history through the USPS links to there. Like, it's quite surprising. It's also fun to watch all the name variations of people. Like, it's and all the different ways that people have like mistyped people's names.
Yep.
It's people are like, what the heck? I was like, you must have applied for a credit card at some point in your life and they typed in your last name, wrong. But I mean, how often you get a card with your name that's not even correct on it? I've seen that before too, where it's spelled incorrectly. I think my husband's name is still spelled incorrectly on his credit card. Like it's not that complicated, but apparently people can't. I mean, you fat finger things, sometimes it happens, but
I'm famous for that.
Yeah. So I guess it's just a little PSA on knowing and understanding credit. If you don't know what your credit report looks like, I'd recommend going through your bank or going through, if you have a credit card, looking to see what it has on there, just to kind of get an idea of what your credit looks like. And then when you are ready to buy a house, if you're not quite there when it comes to credit, I can coach you on things to do through what my simulator says on how to get your score where it needs to be to accomplish what you're looking for. But at the same time too, you might be surprised on what your score actually is.
Yeah, especially if
Yeah. So it's just, don't always think that just because one site says this, that's for sure what it's going to be. It's always best to actually have your credit pulled for a mortgage, because again, your score is going to vary whether you're applying for a car loan, a credit card, student loan, a mortgage. Like your score varies based on what you're applying for. So it can be it's like you could apply for a car loan tomorrow and apply for a mortgage today, and your credit scores could be way different. So it's just knowing that those will vary, and there's no one right answer, I guess.
Just do your research. If you don't know, ask questions.
Yeah, and we have loan programs even if credit isn't perfect, or if you have no credit, we might be able to help you.
It's good to know.
Yeah. All right. Well, thanks for tuning in, and we'll talk to you guys next time.